Get across to FIG Securities, and Bill Keogh joins us now live from the camera there. The question is, I guess some of the brokers, Bill, are talking about some cash coming back into the market, but with all the volatility, what trends are you seeing in cash? Are you still seeing more money switching into that safe haven?
Yeah, good morning, Brooke. Yeah, we certainly are. We're still getting a lot of inquiry on a daily basis to deposit rates and cash rates. I think this is backed up by the latest ABS statistics showing that over the course of last year to 30th June, cash, the flight of money into the cash sector is around 1.7 trillion. For example, households are still saving a lot. Month on month, they're saving around 24%. So we're still seeing a lot of inquiry, and there is a lot of cash coming into the system.
So outside of households, are you seeing other investors getting on board the trend?
Yeah, we are seeing that. I mean, most of the commentators are talking about households. Households make up around about 600 billion of that 1.7 trillion. The other trends we're seeing is for example, super funds. Their allocation to cash has almost doubled over the last year. So that's the allocation at the portfolio level sitting around 15%. Long-term trends around 8.5%, so almost double flight into the cash sector. And also businesses. There's businesses are sitting on record amounts of cash. For example, APRA, the latest APRA statistics show that in August there was around 27 billion that came into the cash sector. Majority of that was from business savings.
What about how it impacts the banks? We can see all the turmoil on global markets, which means some risks on the international funding markets. I guess the banks are pretty happy to see this money coming into those deposits.
Yeah, no, certainly the domestic deposit funding has taken a different significance with the funding books of the major banks, and actually all the approved deposit taking institutions, and certainly does take some pressure off. For the next, it was reported in the media today that 3 out of the 4 majors, major banks haven't got much maturing in over the next 6 months. Next year might be a different story. It all depends what happens in the markets, but certainly the domestic funding from domestic deposits is still attractive to all the approved deposit taking institutions.
So if they're kind of sitting pretty at the moment, and not everyone, but you get this big trend of people wanting to be in cash, do they have to offer attractive rates for much longer? Does that actually end up forcing rates down?
Yeah, well, so that's the supply-demand theory. There is a lot of supply of cash, but there's also, on the flip side, there's the allocation, the asset allocation move. So there has been a significant move into cash and defensive assets such as bonds and cash. Is that going to be a continued trend? Well, proof will be in the pudding, but I suggest that with the underlying volatility in the equity market, property markets still look pretty soft. That I think this trend will continue over the medium term. So essentially you have a larger allocation to cash and fixed income.
And a very quick one to finish. We know that the rates aren't as good as they used to be. What's the kind of rate people can expect now for those term deposits? Yeah,
sure. Look, rates, Brooke, have moved down, but they've moved down with the benchmark swap rates. So you've got a very flat curve. You've got cash at 4.75. The one year swap is around 4%, so you're not seeing 6+% in the 1 year area, but you can still get around the 5.7 for a reasonably well-rated regional bank. So there is still significant value in putting your money out to 1 year in term deposits.
Fantastic, Bill. Thank you so much.
Thank you, Brooke.
Bill Keogh from FIG Securities.